Hi there everybody and welcome back to another stock analysis video. I'm going to be tackling all of your guys' suggestions today, and we actually have another one in the form of Perion. This was actually brought up by the commenter of Pad with like 5 D's and a 1 afterwards, where he pretty much just said, can you please check PERI? Think it's the ad tech stock with the best upside potential. So let's take a look at this company's fundamentals, guys, to see if maybe he has a point when it comes to this. We're going to be using this kind of free cash flow. It actually does work for this company. So with that said, let's get started with this analysis. We are going to jump into the calculator, guys. PERI does not have any dividends, which is actually a good thing, especially if it's a really small company. As you can see here by the market cap, it really is a small company. But nonetheless, guys, ticker symbol of PERI, market cap of $832 million with a PE of 15.17. So it's actually looking fairly decent at a current share price of $18.73. Fairly good. Now the fact of the matter is that, well, if we actually take a look at this company's stock price at the 52-week range, we can see that the highs that they've been so far this year has been $33.09 and the lowest of $16.41. So guys, with the current share price, as I just said, of $18.73, we are essentially in the lower range, closer to all 52-week lows. So this might actually be a fairly decent price at this point. But we're going to take a look at other metrics, cash flow, revenue, shares outstanding, to come up with a better representation of this company's intrinsic value. Now, they do not pay out a dividend, which is actually a good thing, because a company that pays out a dividend that's this small probably will not be able to sustain it. You want a company that has excess amount of cash flow that they are able to actually give out a dividend. As you can see right here, when it comes to their 5-year average free cash as well as last year's free cash flow, it is looking fairly good, but it is not as big as you would normally see it when it comes to other mega caps. Therefore, the fact that they do not pay out a dividend is actually a good thing. Let's see if they're actually rewarding the investor through share buybacks instead. Now guys, let's analyze some fundamentals, and before we get started, I did this in my last video earlier today, and that was the fact that we're actually going to be putting in a couple of grades when it comes to each metric, depending on how good they are, based on essentially if it's positive for starters and if it is consistently increasing year over year. So we're going to be doing that, and then we're going to come up with an overall grade for this company based on these fundamentals. So let's get started with analyzing these, starting of course with the net income 5 years ago of negative $72.8 million to 1 year ago, guys, of $38.7 million. Now that is a pretty good increase of 153%. However, guys, why was it negative 5 years ago, right? That's a question that I highly suggest, especially you, Pad, that asked for this company, figure out why they did negative net income 5 years ago. I don't necessarily know. If you think that, oh, they did negative because of these reasons, and it's understandable as to why, right, and it probably won't happen again, then it is a safe bet that it won't happen again. But taking a look at these other net incomes when it comes to 4 to 2 years ago, unfortunately to say, they were essentially nowhere, right? They were $8.1 million 4 years ago, 12.9 or essentially $13 million 3 years ago, and back down to 10.2 2 years ago. Now this net income from 2 years ago can be attributed to COVID. I mean, we see a similar decrease over here with the free cash flow, right? We see a decrease on the 2 year, but nonetheless, the fact that this just didn't increase as I would like it, don't get me wrong, a negative 72.8 to 8.1, that's fairly good, but it just doesn't, I don't know, this just feels very weird to me, just the way that this graph looks like. So for that reason, guys, because it's positive, you know, and I'm going to say that this was a COVID related number, but I'm just not liking these numbers over here, I'm going to put this grade for the net income at around a 60%. Now coming down to the free cash flow, guys, the most important profit metric that we have, because cash flow, it is cash from operations, less your capital expenditures. It is the metric that pretty much a company uses to operate as a whole. Companies use cash flow to pay out a dividend, to buy back shares, to pay down their debts, to make acquisitions, and to overall grow the company. And a company that is this small really does need to have positive free cash flow, as well as increasing free cash flow. And as you can see right here, when it comes to this, well, 5 years ago they were at $34.4 million to 1 year ago of $70.5 million. That is an increase of 105% with a 5-year average of $40.2 million. Now, I did say in the net income that, hey, free cash flow 2 years ago, it did go down. And it did go down by almost half, right? 3 years ago, they were $43.5 million to 2 years ago, $21.7 million. So that was a pretty drastic change. But what's even more concerning here is that from 5 years ago to 4 years ago, they went down also. Not as much, but they did go down by around $4 million or so, going from 34.4 to 30.8. This is another instance as to you guys should probably do more research as to what caused this decrease. Again, if the decrease isn't that big of a deal, you figured out, oh, okay, this is the reason why this happened. They probably had a couple more capital expenditures, right, that year. If they did a couple more capital expenditures because they wanted to grow the company, then that might actually not be a bad thing as to why they did slightly lower free cash flow, right? Free cash flow is cash from operations less your capital expenditures. Capital expenditures could be used to, buy new equipment, whatever it may be, which can overall just get you more return on investment. With that said, guys, the fact that they did go down from 5 to 4 years ago, it's not necessarily a bad thing, but I highly suggest if you're interested in this to look up what that capital expenditures went to. Now, based on all this, guys, this actually isn't looking too bad, but you do have two down ones, even though one is COVID, which I'm going to ignore. This one right here is kind of concerning, but it's still not that bad, right? So for that reason, I'm actually going to put this at an 80%. It's not too bad. It's fairly good, and it is increasing as well. That's why I'm giving it an 80% for the free cash flow. And now looking at the revenue, 5 years ago of $274 million to 1 year ago of $478.5 million. That is an increase of 75% on the 5 year, but what actually is fairly concerning here again is that, well, they did go down, guys, from 5 years ago to 4 years ago, but from 4 years ago to 3 years ago, they did go up slightly, and from 3 years ago to 2 years ago, they went up again. Very, very similar to what we saw here in the free cash flow, except when it came to the revenue, we don't really see the impacts of that, of COVID, which is actually really, really good to see. So based off of that, guys, I'm actually going to give this one a little bit higher than that of the free cash flow, and let's just bring it to an 85, because again, we did see a decrease from 5 to 4 years ago. Definitely something to take into account. And now analyzing some balance sheet numbers in the total assets minus the total liabilities. Can the company survive an economic recession, which we are in currently right now, for the colloquial term of 2 consecutive negative GDP numbers? Well, we want to see if the company's assets can overtake their liabilities, because if they can't, then you're really, really bad trouble. Now, as it stands, guys, currently they're at $485.8 million in this difference. But what is really, really surprising is that, well, from 2 years ago to 1 year ago is when they really ramped up this difference, right? They went from $184.1 million to a whopping $467 million. Throughout the 5 to 2 years ago, roughly flat, even though they were slightly increasing, and then we just saw a massive increase from 2 to 1 year ago. So this is good, but it's not consistent enough for me, and I understand that this jump, I guess you could say, is a good thing. It's not consistent, and consistency is what I like to see when it comes to pretty much any metric, right? So looking at the total assets, we get $431.05 million. Average liabilities around $166.2 million. And doing this difference on averages, we get $264.83 million. So as it stands, guys, when it comes to this is looking good. Sure, they are in the positive, but unfortunately, this right here is kind of concerning me. It's not consistent enough. So I'm actually going to have to give this at around like a 75%, maybe like a 73% grade for the total asset minus liabilities. It's good, don't get me wrong, but it's just not consistent enough for me to be comfortable with this kind of metric. And now looking at the cash flow minus the total liabilities, because even though assets minus liabilities tells you whether or not the company is able to survive a recession, cash flow is what companies use to pay down their debts. So looking at this metric, what I'm essentially doing is I'm taking the cash flow and I'm adding the liabilities and seeing if at least their cash flow is exceeding their liabilities, or their liabilities are decreasing while the cash flow is increasing, getting this negative number closer and closer to zero. Most companies have negative numbers, and just because cash flow does exceed liabilities doesn't mean that the company will use their cash flow to pay down their debts. This is just a what if scenario. As you can see here, they are getting deeper and deeper into the negatives. Currently, as of last year, they're at negative $175.8 million. But here's something fairly interesting too. This started to happen 2 years ago during COVID, where they went deeply in the red. If you take a look at the 5-year ago number to the 3-year ago number, you can see that they were actually getting closer and closer to zero. And because of COVID, they just had to ramp up their liabilities, or probably the fact that their cash flow did go down. However, we just saw up here that their cash flow pretty much went down 2 years ago, but last year's free cash flow, as you can see, was the highest out of the 5 years, yet the cash flow minus the liabilities was more negative than the previous years, pretty much just telling me that their liabilities significantly went higher. So that's something that I don't like to see, the fact that they're taking way more liabilities. Now, when you take the average cash flow and subtract the average total liabilities, we get around negative $116.4 million. And unfortunately, because we're seeing this getting deeper and deeper in the negatives, I'm going to have to put this at a really, really low score, guys, at around maybe like 55% or so. And now looking at the shares outstanding, the metric that people tend to overlook, and well, you don't want to overlook it because this one is the one that tells you if the company is diluting you as the investor. You want this number, guys, to be decreasing. However, when it comes to really small companies like this, you actually tend to be increasing, especially if the company feels that the shares outstanding price is actually very, very much overpriced. As you can see right here, well, it's actually fairly surprising. From 5 years ago, guys, they were at $25.9 million to today at $44 million. That's a massive increase in the 5 year of almost 70%. And from the previous year to the current year, this is looking at 1 year ago, 43.7 million shares to today, as I said, 44 million shares. This is an increase of almost 0.7%. Now, the reason why I said this is interesting is because from 5 years ago to 2 years ago, sure, they were increasing it, but as you can see, it was roughly stagnant, or at least the rate of increase wasn't a lot. But as you can see, from 2 years ago to 1 year ago, massive jump in shares from 27.4 million to 43.7 million. Probably a COVID related thing, but nonetheless, it is still a dilution on you, the investor. And for this massive share dilution, I'm going to have to put this even lower than that of the previous metrics, and I'm going to have to go, guys, at around a 40% grade. And lastly, when it comes to the cash equivalents, they currently have $93 million with an average cash around $59.02 million. Now, before we get into the target share prices, let's actually analyze this in its entirety to see what the total letter grade is. As you can see right here, well, based on all the percentages that we were given it, with a weight of 20% for the net income, 25% for the free cash flow, 20% for the revenue, 10% for the total assets minus total liabilities, 10% for the cash flow minus the liabilities, and a 15% weight for the shares outstanding, we can see that the total grade for this company, at least what I'm giving it, is 68%. It's getting really, really close to that 70% marker. However, what I would definitely think that is bringing this number down, guys, is this shares outstanding. They did increase it by a whole lot. In my personal opinion, that is not good, and they're diluting you as the investor, which I personally do not like. That's why I'm essentially putting it at just under 70%. At 68%. And now it's time to make some assumptions, low, medium, high, using 3 different factors: revenue growth, the projected share buyback, and of course the required rate of return, which I like to personally keep flat at 10% to match the S&P 500 on average. So for the revenue growth, guys, let's come over here to the growth tab in Seeking Alpha, and we can see that the revenue growth forward, guys, is actually 30.36%, and the revenue growth year over year has been 46.1%. Now, my job, guys, is to be conservative when it comes to investing in companies, especially companies that are brand new, because they have a lot more risk than mega caps or companies that are well established. And on top of that, guys, we just had the news this past week that we are officially in a recession. We had 2 quarters of negative GDP. Therefore, we're in a recession. And on top of that, last month, we just got inflation data of 9.1%, the highest thus far. And on top of that, guys, the Fed just increased interest rates as well by 75 basis points. So unfortunately, I would love to put this company at a revenue growth similar to that of the forward. However, I'm going to be conservative with my assumptions. And for that reason, for the low assumption, I'm going to a 15% revenue growth. For the medium assumption, let's go with 18%. And for the high assumption, let's say 21%. Now for the projected share buyback, well, unfortunately, guys, they are diluting you, and I don't think that this is going to stop. Now, at what rate they'll do, I don't necessarily know. So for the low assumption, guys, I'm going to say that they will issue shares at around negative 25% within the next 4 years. Negative just means that they're issuing shares. Positive means that they're buying back shares. Now for the median assumption, let's bring this down to negative 23. And for the high assumption, let's bring this down to negative 21. Now with this, guys, we get some target share prices, not adjusting for debt as well as adjusting for debt. So you can see right here for the low assumption, this puts me at a price of almost $6 for the low assumption, $6.69 for the median assumption, and $7.48 for the highest assumption. Now adjusting for debt, the way we do this is we take a look at the net debt, we add the cash and equivalents, and if they have more debt than cash, then this number comes down, and if they have more cash than debt, then it does come up. So you can see it does come up, guys, to $13.60 for the lowest assumption, $15.07 for the median assumption, and the highest assumption we get almost $16.70. Now adding a margin of safety on top of this of 5, 10, and 15%. This puts me between the buy range of $11.56 to almost $13. For the median assumption, we get $12.81 to $14.32. And for the highest assumption, we get $14.19 to $15.85. Guys, the current share price is $18.73. So we have a couple numbers here that pretty much just tell us, hey, you might actually consider buying this now because we're only about $2 off, right? However, there are also a couple numbers here that say, whoa, you still need to wait for this thing to drop around like $10 or so, right? So it really just depends as to what your assumptions would be. As you can see right here, I would personally believe anything between the median and high assumptions might be the correct answer, right? But then again, guys, every investment is the present value of all future cash flow, and this is not financial advice. That's why I have this calculator available for free. Anybody can have it because your assumptions will determine what you pay for this company. For example, let's just say that you believe that they will do a 31% revenue growth in the next 4 years, like Seeking Alpha. Let's just round it up to 31%, right? Let's be very, very aggressive when it comes to this assumption. So let's just say 31%, and you think that they're actually going to issue shares, but at like negative 5%. Right then and there, guys, now the target share price adjusting for debt is $25, and the target share price not adjusting for debt is $11.74. So it really just depends as to what your assumptions are for this company in the future, and of course that should be further based on the research that you do by looking at their earnings and just overall reading what the company is planning to do when it comes to research and development and overall growing the company in the future. That is why, guys, I have this calculator available for free. Anybody can have it. It's in my discounted free cash flow calculator videos. In fact, there's a playlist just called Calculators that you go in there, and the videos that say discounted free cash flow calculator update and the one that doesn't say update, they both have links in the description to the spreadsheet. I also, guys, have a book value calculator as well for companies like banks, insurances that don't necessarily have capital expenditures. I also have a reevaluation, which hopefully I get to use one day. Fortunately, there aren't a lot of REIT companies out there. And lastly, I also have a dividend tracking sheet for you guys to track companies with dividends, or for you guys just to track your gains if the company doesn't pay a dividend, right? You guys have this ability. All I'm asking for in return, guys, for these free calculators is just help me grow my channel, like, subscribe, comment. It really does help here with the algorithm on YouTube. And, I'm giving you guys free content, I'm giving you guys free calculators. And all I'm asking for is for something free in return. Thank you so much for everybody who have subscribed so far. Really appreciate it. That's why I'm really, really happy to give you guys free content as well as free stuff. All I'm asking for in return is just help me grow my channel. That's about it. All in all, when it comes to this company, I gotta say, when you said, I think it's the ad tech stock with the best upside potential, I actually kind of agree with you here. Obviously, they're not perfect, but, well, at least in my scoring, I gave it a 68%, guys. That's not too shabby. I think that I'm going to start looking at companies when they reach my 70% or higher. 68%, guys, is fairly close. And I think the main issue here is this shares outstanding. It is very, very high, right? They are increasing their shares, obviously, by a huge amount. If they were to be buying back shares, this number would be significantly higher. I would put it at like maybe 80% or even 75%. But I think that's the main reason why. But overall, I honestly agree with you that this company may have a lot of upside potential, but that doesn't mean that you don't do further research, because anything can go really, really bad, especially in this kind of environment that we are currently in. That pretty much does it for this video. Like to feel like, comment, subscribe. As I said, you guys can follow me on my new tech sites. Link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.